Hello, income investors. Welcome back to the Harvesting Income channel. Make your income and grow your income. Today, we're going to talk about an interesting fund which is focusing on the cash cows. Imagine investing in a bunch of blue chip cash cows or companies which generate free cash flow every year or every quarter. That's the kind of companies that this fund is focusing on. This is basically the cows ETF. Cows is the ticker symbol, and it's from the Amplified ETFs. Name of the fund is Amplify Cash Flow Dividend Leaders ETF. Is it really, too good to be true, or how does it really work? That has been the question that has been, popping up on my mind when I came across this. We will dive into this and see how it works. Will this be a good, alternative to, covered call ETFs? Okay, before we go ahead, quick disclaimer. This is all for entertainment and education purposes only, not financial advice. So with that out of the way, we are talking about Amplify Cash Flow Dividend Leaders ETF, which is known as the COWS. And this is focused on high free cash flow companies. So companies which have historically high free cash flows, plus they have future cash flow potential as well. Those are the companies picked by the fund managers at Amplify. So they look at the past track record, plus they also look at the future potential as well. So there are a lot of research and a lot of data mining that goes into this selection of stocks. And once these stocks are identified or selected, they go through more shortlisting process. And in every portfolio, the industry weighting will not be more than 24%. Like the maximum weighting for a single industry will be 24%. Like so, which means that they don't want to be concentrated too much into one sector, like information technology or financials, for example. So that ensures that it's more diversified, more broad based. Okay, so the last part is like the fund will give you some small distribution, but main focus will be the long term capital appreciation, and that's going to be the key focus. And value creation is the key focus. The small distribution you get, yeah, that's a extra icing on the cake. So that's the whole packaging of the strategies, free cash flows, and diversification across industries and combination of high capital appreciation and some distributions. Okay, the ticker symbol is cows. So we have the other basic information. The price is about $35 USD. The fund is about 3 years old, roughly, probably 2.5, 3 years. And net assets is not much, like it's 33 million, not a big fund. But if you look at the expense ratio, it's 0.19, which is pretty decent, like for this very, affordable compared to other funds. However, this fund doesn't do any covered calls and any option strategies. So yeah, for the research and for the stock selection and customized diversified portfolio, this is reasonable. And more information, you can go to Amplify ETFs and look at the facts and figures and latest fact sheet. Now, when I looked at the performance last 1 year, price return as well as dividend yield, I will tell you what are the findings that I have. Share about if you look at the 1 year performance, like in terms of the capital appreciation, it's about 27%. Like 1 year ago, it was like $27.59. You can see that on the screen. And that was May 23, 2025. And currently it is about $35.08. It's 27% appreciation over past 1 year. Now, this is just a 1 year snapshot. So, you can check out 3 year or 5 year performance, longer term performance yourself. But I looked at the 5 year return and it's approximately, 37% roughly. And the returns have been consistent over the long term. And this is the data I have, like, but don't take my word for it. You can check the facts and figures yourself. And this is not investment advice. So just take this with a pinch of salt. I'm just looking at the 1 year, data. Okay. So with that, let's move to the next part, which is the dividend yield. So when I did the math for the last 12 months, added up all the dividends, comes to about 58 cents. You see the distributions on the right side of the table, and the yield works out to about 2.1%. So this yield is actually typical for any dividend or diversified fund. So I don't think this is too high or too low. I think this is reasonable because you have all types of stocks combined into one. And this fund is more focused on the free cash flow, not the dividend stocks per se. And there's no covered calls or no option strategies. And the focus has been on the higher capital appreciation. So I feel this would be reasonable. And given that we have got 27% appreciation on top of this, I mean, that's a great performance. So putting it all together, like capital appreciation 27% and distribution 2% yield, it's about 29.3. 29% is a very high number. This is probably the recent performance. Like probably it's a bull market. You can say recently, index is going up. Recently, we are in a bull phase or market. Things may turn around, turn back, or things may go down later on. Yeah, absolutely agree with that. Capital appreciation is excellent for this fund. So in a good market, it will appreciate, and total returns are also attractive. Uh, the one thing that I see here, some investors may not like, is the monthly distribution. It's not as high as in other covered call ETFs. Like so, that also explains the lower erosion. Like you don't see this fund eroding capital. So that's a good news. But probably someone who is looking for pure income fund may not like this approach, or they may not like this kind of low yield. Uh, just giving you the information so you can make your own decision. And what's in it for you? So I'm just putting the pros and cons, but not in a very detailed fashion because this is something you need to study further. This is a fund which has a strong long-term capital appreciation potential, and I would like to just highlight the first point. There will be nominal distributions, like that's the expectation that you need to have, and the future value creation or building wealth or future planning, asset creation or retirement funds. If you are looking from that point of view, um, assuming that you want to build wealth for the future, let's say 15 years from now, 20 years from now, 10 years from now, whatever. So in that case, you are able to do that with this fund. Like you're able to create that long-term capital or purpose. But the short-term income is going to be pretty less. So it's just the opposite of what the covered calls are doing. So in the covered calls, you are trying to make the current income higher, and you're sacrificing on the capital appreciation potential. This is just the opposite of that. So people who are looking for this would benefit from this. And secondly, this is not a typical covered call fund, so there is no upside cap. So when the market is going on a very big tear, especially a bull market, and it's slashing all the records and moving up, that's what happened in the recent times, right? The S&P crossed 7,500 and went all the way to record highs. So if you're looking at something that can capture that upside, then this fund is a good pick for you. And thirdly, the fund manager is going to be doing active stock screening, and they're going to rebalance the fund every quarter. And free cash flow is going to be the focus of the fund. So the choice of stocks will be companies which have performed really well and they're able to generate free cash flows. Think about the big investors like the Warren Buffetts and all the big investors that we hear in the news. They pick companies that have this strong free cash flow generation potential. So why not pick up a fund which does the work for you? So they have the fund manager, they have the professionals who do the research for you. That's the advantage of this fund. And you don't have to pick a specific index or any specific formula. Like instead of that, you are giving the fund manager the active ability to pick stocks which do well in different market conditions. So the fourth point is like the fund has about 40 stocks, which is not small in number. It's fairly diversified across different sectors. So one sector doesn't exceed 24%. And concentration of stocks is moderate. Like probably every stock will have like 2.5%, like, and it's rebalanced every quarter. So you don't even if one company fails or something happens, you, the entire portfolio is not going to collapse. Like you still have 39 other holdings which are going to perform well. And yeah, the last point I already touched upon a little bit. This fund is not linked to any specific index. So it's not linked to Nasdaq or S&P, any specific index like that. So that means that the fund manager has a flexibility to choose a mix of stocks. They could use IT, information technology stocks, combine that with healthcare stocks, and combine all this with a few other financial, industrial, and other utility stocks and so on. Like, so it's going to be more of a diversified basket. So, that's a very good, combination which you can hold for a long term, because, some stocks perform well in bull markets, some stocks perform really well in the bear market. So if you have this combination, you're going to be, you know, having a set strategy for a longer period of time. I would say it's like a set and leave it for a longer period of time, like set it and forget it kind of thing. And you can also complement this with other covered call funds and other funds like growth funds that you have in your portfolio. So this can actually be a good complement to the existing portfolio for other, covered call investors or even growth investors and so on. So this is what you're getting in this fund. It's not a perfect one, but this would be a good one for people who are looking for a core holding and long-term growth prospects. Uh, what are the risks here? You will have the typical market risks, systematic risks, and since the fund manager is going to rebalance the portfolio, there is a chance that fund manager may reduce exposure to some, super performing stocks. So when they reduce exposure to those champions or the, successful stocks which are giving you very good returns. Let's say the Teslas and the SpaceX of the world, like they reduce exposure to that. You might be losing on that upside potential. However, the good news is that you are also reducing your risk, because if you're too much exposed to one stock or one sector, you're going to get hit once the market turns into a different direction. So rebalancing and managing the exposure, that's a great risk management strategy, I would say. So if you're holding this for long term and allowing the fund managers to rebalance it, things work out well. But if you are someone who is trying to make a short term move or you want to get in and get out, this fund may not be a good option for you. Okay. The last one, this is not an income or cash flow oriented fund. If you're looking for something like a weekly income or a quick income fund that writes covered calls, gives you high dividend yields, probably you may have to look at other funds like Roundhill funds or, you know, probably the NEOS funds, which give you moderate income. This may not be a very high income fund. So that's the expectation you need to have. But this is a very good one if you're looking at a strong capital appreciation and a little bit of dividend, like an icing on the cake. So that's the point I want to stress here. So I hope you like this video and keep watching the channel. If you have any comments or feedback, please drop them below. Have a great day. Happy investing.